Hello, and welcome back to Scale to Exit with Alejandra Santos, your hostess with the mostest. And I'm very excited to bring today's guest. But before we start, I want to ask you a question. What does it take to build a business that not only survives uncertainty, but thrives through it? In a world where economic uncertainties are inevitable, visionary founders must balance speed with stamina, ambition with empathy, and innovation with resilience. So, in today's episode, I am going to sit down with Peter Cohan. He's an author, an investor, and one of the sharpest minds in strategy and innovation. We will unpack what it truly means to scale smart in uncertain times. We dive into the difference between a visionary leadership and a reckless ambition. We explore how cognitive hunger can drive growth or become a trap, and break down Peter's value pyramid framework for building enduring business value. He has lots of books written about all of his frameworks. Peter Cohan, you will find him on Amazon. You'll hear why entrepreneurs must think like both sprinters and marathoners, and what is the difference between an entrepreneur as a sprinter and an entrepreneur as a marathoner. You're going to learn how to lead with empathy in crisis and some of the biggest cautionary tales Peter's seen in the startup world. Whether you are a founder looking to scale or a leader navigating economic uncertainty, this episode is packed with real insights and actionable frameworks and steps to guide you to your next move. I want to share a little bit of his bio. So, Peter Cohan is a strategy consultant, startup investor, book author, and columnist. As associate professor of management practice at Babson College, he's faculty lead for the core undergraduate strategy course and has created popular electives on startup cities, scaling strategy, and generative AI for business growth and strategy. His strategy consulting firm has completed over 150 projects to help companies identify, evaluate, and profit from growth opportunities created by changing technology. He has invested in 7 startups, 3 of which were sold for over $2 billion, and one of which, SoFi, you probably know about them, went public in 2021 at an $18 billion valuation. He's the author of 17 books, most recently Brain Rush, How to Invest and Compete in the Real World of Generative AI. He's a senior contributor at Forbes and a contributor at Inc. Rethink Retail named him a top retail expert every year between 2021 and 2025 and chose him as a top AI leader in 2024. So, without further ado, are you excited as I am to bring him? This is a great episode. Remember to like, share, comment, and I hope you join me in your favorite platform, wherever that is YouTube, Apple, Spotify, wherever it is. Tune in, share, like, comment. Okay, so let's bring him in. See you on the other side. Peter Cohan, thank you so much for coming to Scale to Exit. Thank you so much for bringing awareness and educating everybody that's listening right now, business owners, founders, entrepreneurs, on how to build a business that can be exited at a high business valuation. So you have built an impressive career as a professor, consultant, an investor, and an author. What drives you to do all these professions? What is the main driver of your passion?
Well, I guess I would start off by telling you a little story, which was that when I was a freshman in college, I went to my father and I said, Dad, when I grow up, I want to be a poet. And I love telling this story to my students because they can't believe I just said that word poet. And then I tell them that he tells me, and I don't remember this at all, but he told me to look up the word poet in the Yellow Pages. And for those of your listeners who are not familiar with the Yellow Pages, it is a book that had the telephone numbers of every business in a city or a local community. And so the idea was that I would try to look up poet in the Yellow Pages. I would not see it, and therefore I would realize that if I wanted to be a poet, I could be sure of not being able to pay any of my bills. So that was sort of the first thing that I was exploring in my career. And then I went through a number of other ones, like I wanted to be a concert pianist, I wanted to be an architect, and there was probably one or two other things. But when I was a junior in college, I came up with this idea of doing consulting. business consulting, and in particular, I wanted to do consulting for high tech companies. I had taught myself how to program computers when I was 13 or 14, and I was really thinking that computers would probably be a very important thing going on in the world and the economy in the decades ahead. And the idea of strategy consulting was great for me because I was inherently curious. So I think that's sort of the fundamental answer to your question, is that I am like boundlessly curious about everything. And that's why I wanted to do so many things. When I was in college, I wanted to major in everything. I had to narrow it down, but I wanted to major in everything. But I did sort of settle in on this idea of doing consulting for um, high tech companies. And at the time, you couldn't get a job in consulting without an MBA. So I thought, well, I'll work for a few years and I'll get an MBA, and then I'll try to apply for a consulting firm. At the same time, after I graduated from college, I was at MIT doing graduate work in computer science, and I wanted to get a job. And so I talked to the head of career counseling at the business school at MIT called the Sloan School, and he told me that I should talk to this consulting firm that was founded by some former Sloan School professors. I think there were 4 or 5 former Sloan School professors who just decided to take off and start their own consulting firm. So I went and interviewed there, and then I also was interviewing another company, and I got a job offer at the other company. And then I'm sitting at my first day of work at the other company, and I get a call from the consulting firm, and they said, "Well, we'd like to bring you in for some more interviews." And I said, "Well, I just started working at this other company, so I'll happy to talk to you, but better do it fast." So, to make a long story short, I interviewed there. I got an offer, and I quit the job that I worked at for one day to go work at this consulting firm, which ended up being a tremendous opportunity for me. I had no idea how great the opportunity was going to be, but it was absolutely fantastic. I loved the people. The work was really interesting. It was just like, I think it was the best work environment I ever had in my entire career. So I really really liked it. I happened to have some really very high degree of luck there, in that I met the woman that I married there, and I also met the guy who helped me start my consulting firm there. So that's just an amazing piece of luck that almost didn't happen. It reminds me of this movie Back to the Future. I don't know if you ever saw it, but I won't
Yeah.
even go into all of it, but it has to do with the photograph, and the photograph sort of goes into focus and then fades away depending upon whether or not Marty McFly's parents are going to get together at the high school dance. So that was sort of what I was thinking about when all this was going on. How different my life would have been if I hadn't happened to get that telephone call there. So anyway, I'll kind of speed it up a little bit. I basically worked there for a while. Then I went to business school, and I got into working in a consulting firm founded by a professor at Harvard named Michael Porter, who's really famous for strategy. And
Mm-hmm.
at the time that I worked there, it was a pretty small company, and he was just getting super famous. So it was the ultimate place to be as far as I was concerned. And I worked there for about 3 years, and then I got sick of all the traveling and spent about 7 years as an internal consultant in the banking and insurance industries, and then started my own firm many decades ago. And so basically, this fellow that I worked with, the first consulting firm, had took me out to lunch. We talked about a project he was working on. He said he needed some help and asked me if I could help him, and I said sure. And that turned into a big consulting firm. So I did that. I did started doing investing in startups. Invested in 7 startups, and 3 of them failed, and 3 of them were sold for over $2 billion, and one of them went public 5 years ago at about $18 billion valuation. And then I
Wow.
started teaching about 20 years ago. I became full time teaching about 10 years ago at Babson College in Massachusetts. I've written 17 books, created 10 courses. I was even in a movie.
How do you balance all of that? I mean, that's a lot to do in such a small period of time.
It was not such a small period of time. It was over several decades. I'm just telling you the story, kind of speeding it up. But you can ask me more questions.
So, with over 150 strategy consulting projects under your belt,
Yes.
what are the most common growth challenges that you have seen that startups face?
Well, I mean, the most common thing I mean, I don't know if that gave me a perspective on the most common challenges, but one of the things kind of projects that I worked on most often were established companies. A lot of companies that I worked with were large Japanese technology companies and they were very interested in learning about new technologies. So during the course of my consulting, I helped companies with the internet. I helped them look at specific aspects of it, like internet consulting or cybersecurity. Also, how to do e-commerce, all these different aspects of technologies. They were looking for ways to take advantage of new technologies so that they could grow faster. So that was sort of the common theme of all my consulting projects. So I would say that that is a very common phenomenon. One of the things that I just kind of skipped over was that after I wrote my first book, I ended up going on television. There's a network called CNBC where they talk about stocks. And I went on CNBC the first time. I was in New York, sitting next to the anchor, and just absolutely terrified. I mean, if you've ever been on TV, the first time you go on TV, it's like very scary because you're thinking about all the people who are watching you, and what if you say something dumb or
All the
make a
things that you're
mistake?
going to say
You're just
wrong. Yes.
like worried, and you don't even know exactly what they're going to ask you and whether you're going to have a good answer and all this stuff. So anyway, I did well enough, so they kept asking me back, and they asked me to talk about stocks, and I didn't really. I mean, I had a business school education. I know the theory about what makes stocks supposedly going to go up and down, but frankly, does that really work in the real world? And so I was really asking. They were asking me to talk about stocks, and I had to figure out, well, what exactly does make them go up and down. And eventually, I figured it out. And so that is an important thing that I figured out that I share with my students, and it's sort of the primary thing driving a lot of my books, which is it's a very simple idea. All my sort of research and all my books are related to one thing, which is growth. How do you create expectations beating growth? And the expectations are mostly coming from investors. And so that's one of the things that I think is very true of publicly traded companies is that investors have very specific expectations. And if a company exceeds those expectations and then forecasts more growth, then the stock will go up. If it fails on any of those dimensions, the stock goes down, sometimes a lot.
So you're saying that so what are the common growth challenges that these companies face when it comes to meeting those expectations?
Yes, so that is a very yes. You've been asking me this question a couple times. I really haven't answered it yet, but now I'll try to answer it. Essentially,
That's
what
good.
happens is that companies that get to the point of being able to go public, or even scaling to a pretty large company, they are successful with one product, their initial product, their core product, whatever they started doing initially. They happen to figure out or luck into a really good fit with the needs of customers.
Hmm.
And the problem that always happens is that whatever that product is, it doesn't keep growing fast forever. Eventually, the growth slows down. They've saturated the geography they started in, and they have to expand geographically. And once they've saturated the world, then they really are in trouble with that product. Eventually, it's going to slow down. It's going to attract new competitors who are going to offer the same product at a lower price, or
Hmm.
maybe even come up with a new product. But you need to invest in a new growth curve.
Hmm.
In that new growth curve, if you're lucky, it will grow really fast, slow down, and die eventually. So you have to keep investing. And so that is the biggest problem in sustaining growth is that companies find it much easier to just try to surf that one wave, that first wave, as long as possible. But eventually the wave just ceases to exist. And so you have to be always looking at where is that next growth curve going to be, and how can I use the resources I have for my current business to invest in that so that when this other wave kind of flattens out, I have something new that
Hmm.
I can surf on.
Yeah. I like that you said that because that could be also complementary to each other, right? It can complement, enhance value. You can be, like what you said, hitting a new diversified kind of customers, right? Customer targets. Now you're creating a whole ecosystem of something new rather than just sticking to one thing until it doesn't work anymore.
Yes, and this is an interesting an interesting topic to me because uh, for the past 8 years I've been the course chair for this required undergraduate course on strategic problem solving, and so I'm like responsible for making sure all the faculty are kind of working in roughly the same direction. and bringing on new faculty. And the thing that's really interesting to me is figuring out how to help people think about the growth question. And so I wrote a book called Disciplined Growth Strategies, which is sort of a text that kind of describes my philosophy of how to grow. And one of the key frameworks in there is the 5 dimensions of growth. So that's sort of where do you look for new growth.
Mm-hmm.
So it's kind of helpful if you are CEO of a company and you feel like your growth is slowing down, or you're afraid it's going to slow down. Where do you look next? And so I could talk about that framework if that would be interesting to anybody.
Yeah, let's talk about it. I mean, we have a lot of frameworks to talk about, but let's talk about that one too.
Yeah, I do have a lot of frameworks. I was talking the other day to somebody, and I said I really should put together a comprehensive list of all the frameworks I've developed and taught over the years. But this one is basically mostly common sense. I mean, you can sell your existing product to more of your current customers, more of your current customer segment, or you can look at finding another customer segment.
Mm-hmm.
So, if you're selling to businesses, for example, many companies start off selling to small and medium-sized businesses,
Mm-hmm.
and then maybe they should look at larger businesses,
Mm-hmm.
or even Fortune 100 or Fortune 500 companies.
Mm-hmm.
So basically, those are different customer segments. I mean,
Mm-hmm.
you can look at it also as customers could be consumers. So there's different consumer segments. There's people of different income levels. There's people who live in different, have different ages and there are different stages in their life and things like that. So there's all these other segments that you could be looking at to see whether your product would be of interest to those customers. So that another dimension, which is another fairly obvious dimension, is geography. You can try to sell more to your current geography where you're kind of currently selling, or you can expand into new parts of the same country or go into new countries, export, all that kind of stuff. It gets more interesting to me when you start talking about product. You can essentially, in my view, there's like 2 fundamental dimensions. There's probably 3, but 2 that really make the most sense. One of which is to build your own new product, and the other one is to acquire a company that gives you that new product and
Mm-hmm.
gives you customers. Earlier today, I was talking to the president, chief financial officer of a large publicly traded company that just made a $3 billion acquisition of basically a startup, so they could get a new product that they were looking for to help expand their business. And essentially what they were doing, which is, I find this kind of interesting, because there was a company called Cisco Systems that used to do this a
Yeah.
lot during the 1990s.
Mm-hmm.
And basically they would acquire startups who were making products that their customers wanted to buy. And they had the best enterprise sales force in the industry. So if they had a new product coming from a startup that their customers wanted to buy, they could turn it from 0 to $2 billion in revenue within a year or two, because just give it to their salespeople and they have access to all the customers. So that, creating new products or acquiring a company that gives you a new product is another dimension. Then there's these 2 non-intuitive, non-common ways of thinking about growth, which is based on building on your current capabilities or adding new capabilities. And the last one is developing growth through your current culture or a new culture. So you can change your capabilities, you can change your culture, and that can become another vector for new growth. So those are less obvious. Those are less things that people often think about.
Yeah, adding new customers, expand geographically, or adding complementers to the portfolio by acquiring them,
Or
or
developing them internally.
or
And
internally.
one of the questions you have when you develop a new product is, does that new product appeal to our current customers? I mean, one way to
Mm-hmm.
think about this is, well, we just want to we understand our customers, and we can see that they need a new kind of product
Mm-hmm.
that we could develop ourselves. So if we develop it, they might buy it from us, and that would allow us to continue to extend the
Mm-hmm. The life
relationship with
cycle.
our current
Mm-hmm.
customers.
The customer life cycle. Yeah, that's what
Yeah.
every business owner needs to focus on. How do I make more from the one person, right? How do I sell more to the
Yes.
one person?
Yes, and
Mm-hmm.
sometimes your current customers are could be tapped out. They could be going out of business. They could be running
Mm-hmm.
out of money.
Mm-hmm.
but maybe other customers in your current customers market segment
Hmm.
could want to buy the new product. So
The new
that's
product.
a really nice way to look at your business, is to sort of say, can I keep my existing customers buying more things from me? Can I
Hmm.
extend the sort of the lifetime value of the customer by having them continue to buy more products from me, new products from me?
Hmm. Or yeah, hit new customer base, because obviously with everything that's going around too, the political landscape that's changing, the economy, inflation, all of this new variables that are affecting everyone, right?
Yes.
Business owners need to start thinking, should we target new customers? Where should we expand? Maybe to, hit other markets, like you said, or what things can happen? What are things that business owners can do right now, according to you, Peter, with your experience or knowledge, for them to prepare better with everything that's going on in the political landscape in the U.S.?
Earlier this afternoon, I was having this conversation with the CFO, president of this company, and I asked her, what are you doing about all the? I euphemistically refer to it as economic uncertainty,
Mm-hmm.
and it is what I've talked to many business owners in the last couple of months, and read interviews with many business owners the last couple of months, and they just don't know what to do. They are literally paralyzed because they don't know whether a tariff on some important thing that they're importing, or a tariff to the market they're exporting their product,
Mm-hmm.
whether that's going, how high that's going to be, whether that's actually going to be something they talk about or actually gets implemented, whether there's going to be escalating tariffs, and which countries are going to be tariffed for which goods, and which countries are going to be immune, and basically you have it's a very complex decision for somebody who has a global supply chain to decide whether they're going to change the way where they're getting their raw materials from, or
Mm-hmm.
keep it the same. I mean, it's
Mm-hmm.
much easier to keep it the same unless the cost of keeping it the same is really high. But if you decide, okay, I'm going to start manufacturing now in Bangladesh instead of China, or Malaysia instead of China, or some other country which is non-tariffed, I'm going to have to make an investment in that country. But I'm afraid that, what if they decide to put tariffs on that country after I've already made the investment?
Mm-hmm.
Um, so I would just say that, from everybody that I have talked to, the general feeling is nobody knows what to do. Everybody is feeling a sense of shock and some degree of paralysis, because they just don't know what's going to happen. And you have to make investments with some degree of predictability as to the
Mm-hmm.
way the world is going to be,
Mm-hmm.
and nobody feels like they know what the world is going to be like. Um, so that makes it rather difficult. So I mean, one thing that companies can certainly do is, if the tariffs come along, you have a decision to make. If you are importing goods that are now more expensive for you to buy, you're as a company, you're an importer. You have to pay that amount, that
Mm-hmm.
higher amount. If the tariffs have not gone into effect, you can buy all the inventory you possibly can
Mm-hmm.
ahead of time before the tariff goes into effect, and that is a way of hedging for a certain period of time, but it's not going to last forever. But maybe it gives you enough time to see the things maybe settle down in some way, and you can kind of identify a new place where you
Mm-hmm.
could have something manufactured.
Mm-hmm.
And that's sort of perhaps a pipe dream, though, because it may be that we are in a state of constant turmoil for the next 4 years or
Yeah.
more. Who knows?
And that is something, if you can influence demand as well, because consumer feels also very exposed. They don't know what to do, right?
Yes.
With all the jobs that are being laid off. And so how can a company even forecast demand and influence on customer behavior to purchase their product that are bringing here ahead of time? So they're going to have to hold on until that cash, put it on inventory. So they're going to be cash constrained for a little bit until they move that out. If they move that out, there's no really predictability when it comes to the
Yeah, it's
situation right now.
definitely it's definitely a very challenging situation. I mean,
Mm-hmm.
I think one thing we can say is that there are going to be people losing their jobs.
Mm-hmm.
Um, a lot of people in the government have lost their jobs.
Yeah.
I don't know exactly the number, 10,000, 20,000, 30,000. How many could suddenly lose their? I mean, there's 2.4 million people working in the government.
Mm.
So that's another key point is that 70% of economic growth comes from consumer spending.
Mm-hmm.
If somebody is not working, they are going to spend on only the essentials:
Mm-hmm.
food, shelter, I don't know, medical, whatever the essential things are for them, and they won't spend on other stuff.
Mm-hmm.
So if you are a company and you're looking at the way the world is heading, there's likely going to be more people out there who are going to be cutting back on non-essential things. So are you selling something that is essential to a human survival?
Mm-hmm.
And if you are selling something like that, are you selling it at the best price? Because it doesn't take a genius to realize that if people lose their job, they're going to try to find the essentials that they need at the lowest possible price.
Mm-hmm.
So if you're
Yeah.
providing that, your odds of surviving as a business are higher. If you're surviving something if you're selling something that is nice to have, but maybe not essential, and people were going to say, well, I don't really need to buy that thing anymore, then you are in trouble, and you better start thinking about whether you can come up with some way of turning your product into something that is essential to somebody's
Mm-hmm.
survival. More and more people are going to be making this decision. And of course, when you have, and it also creates sort of a problem for the Federal Reserve, which normally is trying to figure out how to increase interest rates to keep inflation
Mm-hmm.
below 2%.
Mm-hmm.
But if you put tariffs on things, that raises the cost to the companies making those things.
Mm-hmm.
And most of those companies are going to pass on at least 2/3 of their higher costs onto the customer in the form of higher prices.
Mm-hmm. Yeah.
And those higher prices will feed into inflation, which will make the Fed want to raise rates.
Mm-hmm.
So raising interest rates raises the cost of capital, and it makes the economy slow down. Maybe it's already slowing down. So you're basically a bipolar Fed. What is the Fed going to do? Maybe the Fed is just as confused as the business owners are.
I think we're all confused. It's a very uncertain time. But I do say this. The past has showed us that resilient business owners in times like this become very creative and innovative, and there's always some businesses actually thrive on this kind of economic uncertainties like the COVID times. So I'm very certain that there's going to be some really good stories come out of this, but I'm also very certain that unfortunately we're going to lose a lot of our businesses.
Yes,
Um,
I definitely think that's true. I mean, I will say this much though. You are absolutely right about how stress, uncertainty can spur creativity. One of my examples that I like to use is because I happen to have interviewed the founders of a company years before it went public, and then it was going to go public. I was going to go public. I think it was in February of 2020. It was a company called Toast. And if you've ever been to a restaurant, you may have seen these Toast devices that the servers are holding. They're basically little handheld computers where they take your order and they transmit it right to the people who are making the food, and so they immediately know what people have ordered. And it's basically a handheld device. So this is a company that was really helping restaurants be more productive and serve people faster and everything. And then they were going to do an IPO in February of 2020. And then 5 years ago, there was this little COVID-19 pandemic, which you may remember.
mm,
So this company noticed that all of their customers were shutting down. Restaurants were not serving people in restaurants because of COVID-19. And they wanted to do an IPO.
that's the
And
worst time to do an IPO.
right, but they didn't know that at
Yes.
the time that they were going to do the IPO. They didn't know that the pandemic was on its way a month later. So what they did was they cut 3,000 employees, and they figured out how to rejigger their technology so that people could place orders with restaurants and then pick them up outside the restaurant or have them delivered by, a DoorDash or something like that, and also help the restaurants to sell gift cards. So they basically rejiggered their business, their service, so that it would help restaurants survive. And the restaurants survived on the things that they were helping them with. And the company went public in the fall of 2020. So that was an example of amazing resilience and quick thinking and acting, and it led to success. And there were a lot of businesses that were super successful during the pandemic.
Mm-hmm.
Pandemic darlings like Zoom and Peloton and Wayfair, which was selling furniture online, not insurance online. And these companies were doing really great during the pandemic, much better than they are now. And this is another example of companies that were doing great during the pandemic who are now not doing great because they couldn't come up with anything that was as in demand as what they were offering during the pandemic. So what are the creative new things? So this is now one of the things that I have I noticed a few weeks ago is that some companies. I was talking about the zombie unicorns. I don't know if we've talked about the zombie unicorn concept.
No, we have not, but let's talk about it.
Okay, so a zombie unicorn is a business. A unicorn in sort of tech talk is a company that's a private company worth at least $1 billion or more. And a zombie unicorn is a unicorn that raised capital before the IPO market for initial public offerings crashed in 2021, which is when my last company that I invested in went public. And after that, the market crashed. So this is a zombie unicorn is a company that was valued at over $1 billion basically before the IPO market crashed. And now they can't go public because the IPO market is shut. And the venture capitalists don't want to invest in them. So all these companies that raised capital either have to change their strategy under the assumption that they need to go from being money-losing, fast-growing companies that skipped what I call the second stage of scaling, and just sprinting to liquidity under the assumption that the IPO market will be open. They have to change their strategy, assuming that there's no IPO market, and they have to become profitable with the capital that they have. So there's this one company that I was writing about a week or two ago that has figured out how to grow with 23 employees, grow to over $100 million in revenue in 18 months. If you have 23 employees, you don't need that much capital. And they were using lots of different kinds of AI to make their 23 employees much more productive.
Yeah.
They were also offering a product that was super, super compelling that just sells itself. And as soon as somebody sees it, they immediately tell all their friends about it and they start using it. So those are sort of the two things that they were doing to, I thought, quite creatively dealing with the stress of an IPO market that is not open.
So talk to me about the scaling index, because we talked about that one.
Something called the scaling quotient. And I've been just spent the whole last couple of days grading midterm exams where I gave students a business school case and I said, figure out the scaling quotient for this company and tell me what their strengths and weaknesses are, and then make recommendations on how to overcome their weaknesses so they can scale to the next stage. So in order to explain this, I need to talk about, I guess, just something called the 7 scaling levers. The 7 scaling levers are activities that a leader can perform that will help the company get bigger. There's 7 different things, and some of them are very clear, like have a sustainable growth trajectory, which essentially means what we started off talking about, which is coming up with always having new ideas of where you're going to get the growth from. Another one that they have to do really well is they have to raise the right kind of capital at different stages in the company's development. So that it's an important point that you shouldn't raise venture capital initially. You should wait to do that until you're later in the development of the company.
I agree with that.
There's another aspect which has to do with how do you structure the organization. what are the boxes on your organization chart?
Mhm.
And then another one is, do you have the right people in those boxes?
Mhm.
Another aspect of it is the culture. Culture is like at the center of this whole thing, making sure that
Mhm.
you have a culture and you can scale the culture.
Mhm.
There's other aspects such as holding people accountable for specific goals that are related to the goals of the company, and and there's another one which is coordinating processes across different business functions so that the company will be seamless and streamlined and deliver good service to customers. So there's 7 of these scaling levers, and for each of those scaling levers, there are specific activities within that kind of you're doing this particular scaling lever right. So the scaling index is basically all 23 or 24 of those little factors graded from 1 to 5, where 5 is the best in the industry and 1 is the worst in the industry. And you come up with a number between 0 and 100. So if a company has a scaling index of 100, they are ready to scale to the next level. If they
Mm.
have a scaling index of 75, you want to look at where are they not doing well
Mm.
and what can they do to overcome those weaknesses. So that was sort of the midterm case that I gave my students, is to look at this company, figure out where the weaknesses are, and recommend how they could fix them. So the scaling index is very. I am just like, I never had used it before in a real given students to look at that and say use this. And the first time I did it, I was amazed how well it worked. I mean, it was very satisfying to see how well it worked, because it really identified very efficiently what are the real problems that this company has, and a lot of the students recognized that, and they came up with some really good suggestions for how to overcome the weaknesses, and explain why those recommendations would
Mhm.
lead to better results.
Which one of those have the most weight, in your opinion?
Well, I had them all equally weighted. Um, and I think what I discovered is that during different stages of scaling, the weighting changes.
Mhm.
It and so, nevertheless, I think that the students should look at all of them. But one of the things that's pretty clear is that when you are at the first stage of scaling, which is essentially trying to win your first customers, there's a lot of those scaling levers which are not necessarily very important.
Mhm.
Like the organizational structure doesn't have to be right. The culture does have to be right, but the culture is not it's not articulated. It's basically you hired a team, and what they're doing. Whatever
Mhm.
everybody's doing is what the culture is, and they don't really know whether it's a successful culture until they get to the second stage of scaling, which is when they're big enough to sort of start thinking about, okay, am I doing this business efficiently? At which point you start looking at how to coordinate processes. So the second stage of scaling, you're trying to see, how can I get big and make sure that I'm doing things in such a way that it will be efficient to sell, be efficient to provide customer service, to
Mhm.
manufacture, to purchase, to perform basic business activities, so that as you get bigger, you get more efficient at doing these things. And so
Mhm.
you can become cash flow positive. So,
Mhm.
in that second stage of scaling, those coordinating processes issues become more important. When you decide you're going to try to scale to an IPO, what I call sprinting to liquidity,
Mhm.
the third stage of scaling, it becomes very important to have a clear organization structure and basically hire executives to run each of those major functions who have had previous experience taking a company public, so they know how to manage those functions. And usually that means that there's quite a bit of turnover, because the people that you had on your original management team like to do all sorts of different things in a very idiosyncratic way.
Mhm.
And now you're hiring these executives who know that in order to make marketing or sales or product development work, they need to have a much more structured process, which rubs a lot of people the wrong way.
So you and I spoke before about the different kinds of founders: the sprinter, the marathon, and I don't remember the other one.
Yeah, the Ambler. The Ambler was the person who sort of this was, and I really like this one because I think there's more amblers than anything else. Because amblers are people who start businesses. And I think we talked about this before. They're amblers, people who start businesses because they want to make a living for their family and employ their friends and relatives.
Mm-hmm.
I don't know. There's so many businesses out there. There's restaurants, there's cleaners, there's many different kinds of shops, services people provide,
Mm-hmm.
lawn mowing services, tree cutting services. All of these are essentially started to employ family and friends and, have a nice life.
Mm-hmm.
It's fantastic. There's lots of these people. I call them amblers because they're sort of walking along at their own pace. But when you get into these more athletic things like sprinting and marathoning, you are now dependent on other people's money. So when you get into the OPM world, the other people's money world,
Mm-hmm.
then you have to become more athletic
Mm-hmm.
as a business leader. So sprinting means that somebody's giving you a whole bunch of money and they want you to take that company public as quickly as possible. Because that's the only way they're going to get their money out. So those are the sprinters. There are many countries and there are many business leaders who are essentially sprinters. They're good at taking a company to that IPO and then they get out.
Mm-hmm. Yeah, that's me.
And there are other people who are, in my view, from a kind of a regional economy standpoint, like city entrepreneurial ecosystem perspective. There's another kind of person, which is I call the marathoner, which is somebody who takes it public and keeps running it many years after it goes public, because they want to make sure that company really makes a difference in the world. They believe passionately in their mission, and so therefore they are very, very motivated to keep learning. And this is one of the things that you have to learn in what I call running the marathon, the fourth stage, which never ends if you're a public company, unless you sell out to somebody else. Every quarter, you have to meet those quarterly expectations, which means that you have to have an entire mechanism for managing what everybody's doing so that you're always beating expectations and raising guidance every quarter. So that whole mechanism doesn't exist in a private company.
Mm-hmm.
And many people who are sprinters do not relish the idea of having to deal with, Wall Street investors every quarter.
All the pressures
So,
that come with that. Mm-hmm.
yeah, exactly.
So you recently commented about Elon Musk's leadership actions in one of your posts. You rose the question of whether he's a visionary pushing boundaries or a reckless destroyer of value. So in your experience, where is the line between being an innovative risk taker and a reckless leader?
Well, I guess the question is whether you have any empathy with other people or not. That's pretty much what it boils
It's
down
a
to.
simple answer. Yeah.
Yeah, I mean, there are definitely some super successful people who did some really innovative things,
Mm-hmm.
who basically treated people mostly pretty well.
Mm-hmm.
Um, they kind of they had some boundaries in terms of
Mm-hmm.
what they viewed as acceptable behavior. So for example, I would say that I don't think any of these people are perfect. I'm sure if I dug, I could find bad things that they had done. But I think, for example, Reed Hastings, who's the founder and co-founder and CEO of, or co-CEO now of Netflix. I think he strikes me as basically a decent human being who has, taken an idea and turned it into an entirely new industry. He definitely is a tough leader, but he's respectful of people in the sense that he, tells them what is expected of them, gives them a lot of leeway to do it, and tells them that, I will replace you if you are not the best person for this job, but you know that going in there, and then when you leave, you are very valuable to the rest of the industry because you've worked on the best team in the industry.
Mm-hmm.
So
Mm-hmm.
to me, that is, kind of, there's sort of an intellectual honesty to that, where there is some concern for the impact of business, setting ambitious business goals and having a team of people who are going to achieve them. That I think is he's got some boundaries of human
Mm-hmm.
respect.
Mm-hmm.
I think uh, I probably wrote in my article. I know I've written in articles about how much value was destroyed when he acquired Twitter. I think that he paid $44 billion. The value went down 72%. He fired, I don't know, 80% of the people, and did all these really nasty, nasty things. Um, I could go on a litany of all the things that I do not like about the conduct of that person. Um,
So Elon Musk is not pushing boundaries. He's a reckless destroyer of value.
yes. Well, actually, he also pushes boundaries. I mean,
Both
unlike
of them.
so I will. Here's what I will say, which is sort of makes it kind of an imperfect. It's neither all bad or all good, but it's a lot of bad stuff. But some of the businesses that he has kind of helped to grow, like Tesla. I mean, there were no very large electric vehicle companies. There were no companies that were doing rockets that would go up and come back. I mean, that's I hate to admit that, because I dislike his behavior, but you got to give him credit for that. By contrast, about 10 years ago, there was this company called Theranos. It was actually started before then, but I'm not sure if you heard the story about that one, but you
I,
did. Yes. I'm looking
everybody
in your
knows this.
eyes.
It's
You're
a
very
good
familiar with the
story.
story. Yeah. So I started writing about that um, as soon as the Wall Street Journal made their initial report. I ended up having an interview with a gentleman who essentially was um, a psychiatrist who grew up with her family, Elizabeth Holmes's family,
Mm-hmm.
in Washington D.C. suburb, and basically knew her since she was a little girl. And I interviewed him and had all these fascinating insights about her psychology. And I was not allowed to publish that until I did this interview in 2015, and I was allowed to publish it, I think, 4 years later, because the lawyers for Theranos were uh, making a lot of threatening noises, and it would have involved a lot of legal
Mm-hmm.
bills for Forbes, and nobody wanted to do that. So basically, after the company went bankrupt, it went bankrupt in September 2018. So essentially, that's an example of a bad person basically coming up with nothing, zero actual business, zero actual product. So this is like I can imagine a spectrum, but essentially the two dimensions are did they come up with anything that was actually innovative and really changed the world and really did something meaningful, and did they do it in a way which was evil or not so evil? So I guess those two dimensions, the impact of what they did and the level of ethics or lack thereof in the process of doing it. So I kind of like the ones where they had a high impact and they did it in an ethical
Mm-hmm.
way. To me, that's sort of my model. So I guess another one who's more on the good side would be Jeff Bezos, although he seems to have gone off a little bit on the deep end from where he seemed to be before. Then again, I don't know everything that he did when he was the more real, like, conservative, or not conservative, but essentially non-offensive seeming person that he now seems more offensive to me. But anyway, it's like nobody's perfect, but it's interesting to sort of think about. You have to have a certain amount of breaking of paradigms to be successful.
Mm-hmm.
Steve Jobs is another example. I mean, he's definitely, in my view, somebody who created some real important things, and also he had some unpleasant human characteristics, but also wasn't nearly as bad as some of these other people.
No, he was definitely not, and he created a lot of value. Like saved a lot of businesses from being going bankrupt, like the Disney one, right? With
Yes,
Pixar. Mm-hmm.
yes, yes,
So talking about value, your latest book, Brain Rush,
yes.
explores generative AI's impact on investment and competition. So how do you see AI reshaping business strategy, competitive advantage, and exit planning? And can you talk about your value pyramid framework?
Yeah. So let me talk about the value pyramid first.
Yeah.
Basically, it's something that I didn't write about in the book. I kind of thought about it afterwards and started talking about it afterwards. But just a little background: I wrote 3 books about the .com boom, um, and so I'm always comparing the .com boom to the generative AI boom. I can tell you that because I had written books about the dot-com boom, which basically started in 1997 or something. And I think my first book came out in 1998 on that topic. I had an intuitive gut feeling that the generative AI was going to be very significant back in May of 2023, when NVIDIA reported a drop in sales, but a
Mm.
huge increase in their forecast for the next quarter, which was all because of generative AI, because related to ChatGPT. And so I immediately jumped in there and I was like, okay, there's tons of hype here, but there's probably something real. So it's kind of harkening back to my experience when I started an AI company. I was one of the first employees of an AI company while I was in graduate school at MIT. And the company failed. And the reason it failed was because fundamentally the product cost more than the value to the customers. So
Mm.
that principle has never really gone away. That
Mhm.
principle is true for dot-com companies, and it's true for generative AI companies. And that's where the value pyramid comes in. So you envision a pyramid. The bottom layer, which has most of the uses of AI, are for people who are trying to overcome creator's block, which
Mhm.
essentially, I want to write an email, I want to write a memo, I want to produce a picture, I want to do a video, and I don't even know how to get started. So this helps you. You type in a few words, describe the concept, and it will give you a good first draft, which helps you overcome your creator's block. So that's like where most people are using it. I view that as being sort of valuable, sort of fun, but not necessarily something that's going to give a business a competitive advantage. If for
Mhm.
no other reason than if anybody could figure out how to get any value from that, it would be really easy for someone to copy it. Anybody who subscribes to Chat or gets ChatGPT for free can do the same thing very quickly. So
Mhm.
if everybody can do it, it doesn't give you a competitive advantage. So
Mhm.
that's the bottom layer of the pyramid. The second layer of the pyramid is what I called boosting functional productivity, which is a fancy way of saying making your marketing or your customer service or your product development or your coding, which is a big thing that people are using it for, writing software, much more productive. So what I found is that fewer companies are doing this, but most of them are focusing on doing it for coding because and I was talking about this in my class on Monday, which was yesterday. So yeah, I've been doing a lot of stuff today. It seems like a long time ago, but yes, I was talking about it yesterday. It's like coding is the most popular way that large organizations are using generative AI because it improves the productivity of coders by 20 to 30%. But the potential damage to the company's reputation is much lower than the damage of a hallucinations from generative AI for a customer service application. So if you use generative AI for customer service, the research says that you would be able to increase your productivity by 30%. But that doesn't take into account something that could just blow the value of that productivity increase right out the window, which is what if it tells you something really, really bad? What if it tells the customer something really bad or just something incorrect? So
Mhm.
a more modest kind of problem with a chat bot used for customer service, I don't know if we talked about this, was that you had Air Canada having a chat bot that gave somebody a fare, and then it turns out that the person was ready to take advantage of that fare, and Air Canada said, no, you cannot because that's not our official fare. And they said, well, I got it from the chatbot. It's your chatbot. And to make a long story short, a tribunal in Canada said that this Air Canada had to honor the offer made by the chatbot. But it can do all sorts of things. It's like I talked to the CEO of a company who was using a chatbot to get a problem fixed with his subscription for contact lenses, and he tried and tried and tried. He was so frustrated that he switched contact lens suppliers because he got such a bad experience. So, I mean, you can imagine all the things that could go wrong with customer
Mhm.
service, and companies don't want to take the risk of having a bad reputation or the board of directors getting sued. So they're more comfortable letting people do improve the functional productivity of coding, which doesn't necessarily directly touch the customers. And then the top level of the pyramid, of the value pyramid, which is where the most value in theory should be, is using generative AI to grow faster,
Mhm.
to create those new growth curves that we started talking about at the beginning.
Mhm.
That's where the real value comes in.
So
And for the
creators.
most part, companies have not gotten there yet.
Mhm. So the creator's block at the bottom, which is what everybody's getting used to doing, right? Like the
Yes,
writing, send me here. The second one is the productivity. What you were saying about the company that had 23 employees, 100 million productivity. They're a very good example of that.
yes,
And
exactly.
then the third one is the growth, right?
Yes.
So
The
what
third
did
one is
Sam?
creating an entirely new line of
Mhm.
business that didn't exist before, that just grows very fast.
Wow. Okay.
And that is what ultimately propels value. This is coming
Hmm.
back to when I first went on CNBC many, many years ago, and not knowing what creates value. And it turns out that value is all about expectations beating growth. So if
Hmm.
you can use generative AI to create expectations beating growth, then that is the ultimate way that you get the payoff from generative AI, which another aspect of generative AI is how expensive it is. So when you think about a business, you like a lot of, you know, you get taught in business school about how you should try to make investments that earn back that earn a return on investment.
Hmm.
They get cash flow profit back that
Hmm.
as a result of making that investment that is more than equal to the amount that you invested.
Hmm. So in your experience, AI generative will depending on how it's used, will definitely generative AI will definitely impact in competition, in competitive advantage, in the investment of the company, in the value. There's so many AI tools right now over there. There's so many competition in AI. How do you know which one of those AI companies or startups will make it through? Because I just recently saw, I don't remember the name of this one, but it's a marketing tool that just went for it 30 million, I'm sorry, 80 million seed round, series B, 80 million at a
Yes,
$30 billion valuation. But when you look at the company itself, it doesn't seem like I don't you cannot add the numbers, right? Like it doesn't make sense.
yes. Well, this is definitely um, a kind of a problem in the venture capital market,
Mm-hmm.
um, which is that most companies can't go public. Most companies are not getting venture capital, but certain kinds of AI companies are getting tons and tons of venture capital, even though they're losing billions of dollars. Like OpenAI, is losing more billions than it's generating in revenue,
Mm-hmm.
and it just keeps getting more and more capital. And one of the reasons is that Sam Altman, the CEO, is incredibly good at talking money out of people who have lots of money. So that is irrational. So I mean, if you are to look at a company that's getting a very high valuation and doesn't seem to have a clear business model, one thing that is probably true is that the person who is talking to the investors is incredibly good at selling investors on investing in the company, and that leads to very high valuations that are
Mm-hmm.
not based on anything. I mean, you can look at the one we were talking about before, Theranos, WeWork. These are companies where the CEOs were incredibly good at raising capital, and making people feel like, man, I got to invest in this company. I'm going to miss out if I don't invest in this company, and they just drive the valuations up super, super high. But this gets to your question: is how do you know when a private company is a good one to invest in?
Mm-hmm.
And that's where I have this thing called the Cognitive Hunger Index, which is about an exam. Is actually I'm giving an exam that's due on Friday, asking students to analyze a company using the Cognitive Hunger Index.
How does this index work?
Well, what happened is that I discovered that I was curious. I read an article in Harvard Business Law Review, which I never heard of before, but it's very interesting. It said that only 0.4% of founders end up running their companies 3 years after they go public. 0.4%. So the other 99.6% are gone before
Mm-hmm.
the 3 years after they go public.
Mm-hmm.
So I was like, why is that? What is it? What is it about those 0.4% that's different from all the other ones?
Mm-hmm.
And the article had nothing on that. It's like, well, this is an obvious thing I need to know about. I am like really want to find out about this. So it turns out I knew a dozen of these CEOs, and I started interviewing them, and then I found more of them. I interviewed about 30 CEOs, and I discovered this one thing that makes them different than all the other ones,
What is the one
and
thing?
that's cognitive hunger. versus cognitive lock-in. So cognitive lock-in is what happens when you have somebody who knows what they know and they've been successful with that, and they don't want to hear anything new. They don't want to hear anything that they have what was called confirmation bias. They want to have somebody tell them that what they already believe is correct. And if somebody contradicts what they believe, they will fire them, or they will isolate them, or make them feel like they don't belong. And basically, they want to try to make them leave. These are people who want to be surrounded by essentially sycophantic people who will essentially tell them what they want to hear. Not interested in learning. Whereas the people with cognitive hunger never lose their desire to learn more. They never allow the success to go to their heads. They never lose their intellectual humility. They never lose their respect for their basic values of respect for other people, for their employees, for their customers, for the fact that there are competitors out there who are competing to offer more value to their customers. So they always assume that they're in that sort of mindset that they may have been in when they first started the company. So success doesn't really change them. Essentially, they're driven by a mission and values that makes them want their company to change the world, and they will learn everything they need to learn in order to keep that company growing. And for a lot of these companies, they have to go public to win new customers, because a lot of customers, business customers in particular, don't really feel comfortable doing business with a private company. So, they basically have an idea, and they have cognitive hunger, and they keep learning and learning and learning. And the cognitive hunger manifests itself in the way that they perform 5 specific activities, and that's where the cognitive hunger index comes from. Because when you look at the 5 activities, there's 3 to 4 specific things that you're doing in each of those areas, and you add it up, and you got about 20, 25 different little factors that you're analyzing. So it's again another one. I like doing that. I have about 8 of these things where you basically try to come up with a number between 0 and 100 for assessing the company's potential to the leader's potential, really, to take this private company and continue to be running it. So it's sort of somewhat of a predictive model based on imperfect information, but I think it's pretty useful because you can learn some things about the CEO, about the leader, about the way that they're behaving, which is probably going to limit their ability to be around for the entire journey.
So leadership, again, is like one of the biggest drivers when it comes to scaling a company, taking it public, keeping it public, staying in that seat. And then we talk about 3 of them. We talk about the growth one, 4, the value one, the scaling one, and then we talk about the cognitive. So you say you have 4 more in your toolbox.
I have lots of them. I wrote a book called Value Leadership, which is how do you take things that you value and then put them into the way that you run the company. And even a couple of years ago, I gave a talk about how you could use this value leadership framework. I had created this thing called the value quotient. Value leadership framework, which would allow you to put that value quotient into compensation packages for executives. So part of their bonus would be linked to how much they improve the value quotient of the company. And I thought that would be a really nice way to motivate people to act according to humanistic values that are basically my values, which are really good values. I think somebody should probably decide whether my values are really good. I think they're really good. I think I'm a really good person, but this is sort of my vision of how companies should be run.
Yeah. So in your opinion, do you think leadership is nurture, a good leader, or nature?
I would say that you can probably teach somebody who has a really good people skills how to be a good leader. I think most companies cannot run with just one person. So most companies really need a leader who is a people person. They also need a product person. And there are some companies where the product person is really good. And so this is a new thing in Silicon Valley. They would take people who are really great product people and they would put around them people who did all the people thing, that had the human skills that they didn't have, and they
Mhm.
would somehow make them able to grow the company. But having said that, I think most companies are not that way, and most companies you need somebody who has really really good people skills, the ability to but also good strategic skills, the ability to sort of
Mhm.
look at an industry and know where it's heading and know where the needs are going to be in the future, and
Mhm.
have the ability to build what's called an A team, essentially the best people, and be very charismatic and be able to attract great people and motivate them to sort of realize their full potential. And I know there are some companies that run with this sort of command and control style of leadership, which I personally do not favor, um, because it essentially diminishes the abilities of the people that you hire. Why would somebody who has great talent or great potential want to work for somebody who just considers them to be sort of a part of their pinky finger? It's like
Yeah. Yeah.
that's not very motivating.
Yeah.
Which
Agreed.
what I'd rather see is a CEO who kind of says, I'm going to create this very compelling mission which will attract really talented people.
Mhm.
One thing I learned in writing a couple of my books is that people like to be around working on the biggest challenges, the biggest intellectual challenges, that they find that to be very motivating. And so you give them a big intellectual challenge that also creates value,
Mhm.
and that will allow the company to grow.
Mhm.
It will give those people an opportunity to develop professionally. And so you're essentially kind of giving people an opportunity to develop professionally. Maybe eventually they're going to leave and start their own firm.
Mhm.
But the
Yeah.
idea is that during their time at your company, they have really developed a lot and
Mhm.
and become much more effective professionals. So essentially, your role as a leader is to take all of your people and develop them to the maximum of their potential, so they can go off and start their own company.
Mhm.
That sort of reflects my values. That's what I see.
That's that's something that you share. Yeah, that you like. That you teach them. You bring them to that level, and then they can, or they stay with you, or they can go. Usually, people grow and they want to build something on themselves.
Right.
But yeah, I do feel like leaders is a blend of both nature and nurture. Just because you can have, like, there are things that you cannot teach. You cannot teach kindness or empathy or respect, right? Those are things that you either have them or you don't.
Exactly. But obviously, there are some people who are quite successful without having any of those things. So
That's true too. Yeah.
I'm definitely in a position of being able to kind of, fortunately, to be able to sort of teach things that I think are right, and and so students can take it or leave it. But that's what I'm going to teach.
So I want to ask you one last thing. We talked about startups that were innovative and creative over stressful times that surprised you. But how about some startups that were a cautionary tale for you?
Yeah, I mean, I definitely had some investments that failed, um, and when I look at why did they fail, um, it was a basic problem. They were not able to get anybody to buy their product. Um, the company that the first company that I invested in, I was very fortunate that I was. These were in the days when they had these things called VCRs. You'd have a videotape of somebody, you put it in a machine and watch it. So I was watching a video, a VCR of the founder talking about all the customers that were using the company's product, and listing off the names of the customers, and it was real. And I was like, this is what I'm looking for: is a company that is figured out how to do something that people want. And basically, the first thing I teach in my scaling course is how to solve the right problem. And so if you're not solving the right problem, it will be obvious because the company is not getting anybody to buy the product. And if you are solving the right problem, it will also be obvious because a lot of people are buying the product and they're telling all their friends about it, and they're all buying the product as soon as they try it. So, that is like the most basic thing in the whole startup world, is
Mm-hmm.
just, are you doing something that satisfies an unmet need?
Mm-hmm.
And one of the things I found in my research, a book that I wrote 13 years ago called Hungry Startup Strategy, is that most of the 130 founders I interviewed, most of them founded a company because they had a need that nobody was meeting. They would have rather had bought the product from somebody to meet that need. And starting a company is a big thing, but they
Mm-hmm.
decided, you know what, this is really important. I care about this. Nobody's solving this problem, so they knew there was a problem there. It was a real problem. They weren't kind of like saying, "Oh, well, I know. Here's this really cool thing called Expert Systems, which is what the AI company I was talking about that was involved in early in my career. Um, let's see if somebody can find some use for it." No, these companies were starting from the good companies are starting from the idea that there's a real customer pain out there, and we are able to develop a way of relieving that pain in a way that's better than other companies out there. Um, and if there's no large companies that are already solving the problem, there's a risk of doing business with a startup, so you have to be much better, which is another concept we talked about, which is the quantum value leap. You have to have a huge increase in the value of your product, the benefits that your product gives to the customer for the price compared to the incumbent products.
Mm-hmm.
And I kind of my rule of thumb is it should be 10 times higher than the existing products to get some customer to switch from a incumbent to a startup's product, or to even try a startup's product. It has to be much better than whatever else is out there.
So I always say that's actually a good point. Product market fit, always. Like it's um I always say if you have a little bit of competition, it's a good sign because you already know that that is validated by the market. There
Yes.
is a demand and you can obviously leverage on that. When it comes, you did say one point earlier though before, that was don't be asking for money at an early stage, and that's a big mistake that a lot of founders are doing when they go for fundraising. They say, I think I need money to solve this problem, and I ask them, is there really money that you is money going to solve your problem, or is it problem of scaling a strategy or something else that needs to go into
Yeah, I
place?
mean, when you get money from the outside, you are giving up control of your
Mhm.
business. Um, and would you rather give up control of your business when you're still sort of experimenting and trying to get that product market fit, or would you rather give up control when you're growing really fast? You've got 50 million in revenue. If you keep going at this rate, you're going to be 100 million in revenue, and you'll be able to go public or sell for $1 billion or whatever. That's a better time to go for outside capital because you've taken away a lot of the risk for the investor, but
Mhm.
you need the extra capital to build the sales force or whatever to
Mhm.
continue your sales trajectory, your growth trajectory. So that's a better time to be getting money from a venture capital firm. But if you do that, you have to interview the partner who's going to be on your board because you want to make sure that they're not going to kick you when you're down. That they're going to be
Kick
somebody who
you.
will support you when you're
Yeah.
down. But before that, you should try to avoid getting money from the outside. Or if you do get money from the outside, make sure it's sort of not they don't take an equity stake in the company.
Mm.
They could lend you money. I know a lot of
Mhm.
people use Kickstarters where they kind of get money from people who then in turn will get an early version of your product once it's released. I don't know why people do that, but they do. So it's somewhat irrational for the investors, but it's great for the company.
Yeah. Yeah. So I love that we spoke to so many great topics. Peter, thank you so much. I know I'm keeping you over the time, but I do think I want to bring you again just because you have a great conversation, great experience, great insights that you share with everybody. Is
Thank
there
you.
anything that you want to add that I haven't asked you before we end the conversation?
No, I think we talked about more stuff than I was expecting, and I like the idea of coming back. If you want me to come back, I'd be happy to.
Yeah, I would love you to come back and we can talk more in depth, about the value pyramid or any other frameworks that you have because you have a lot of in your toolbox
Yeah,
that I still don't know yet, but I'm
exactly.
very
Yes, there
eager
are.
to
I
learn.
haven't even told you about a lot of the other ones, but anyway, yeah, I told you about ones you asked about for sure.
Yeah, I'm very eager to learn. And where can they find you, Peter? Where can everybody connect with you, find you?
Yeah, I mean, they could just look up Peter Cohan and Babson College. Just type that into Google, and it will have lots of information. And I have a website about my business and my investing as well. It's petercohan.com, and then all my books are available on Amazon. So So I think you can go and find my name in Amazon, and they click on it, and there's a list of a lot of books. I don't know if they have all 17 of them, but a lot of books. So yeah.
Yeah, I'm gonna actually download a few of them just to read them, and then because I do feel like you have such a great experience and insights that I can benefit in sharing it with my clients as well.
Yes,
Um,
that would be really good. It would be really neat if it was valuable to some other human.
yes, of course. Valuable to everyone.
Yeah.
Thank you so much, Peter, for coming on board. I am going to put all of where they can find you on the show notes
Okay.
because I do think it will be very beneficial for everybody to go and reach out to Peter Cohan at petercohan.com. Thank you so much for joining us today, and we'll have you next time.
Thank you. Have a great day.
Adios, muchachos.